start off looking at the gas market, we're seeing an oversupply system at the start of this week. One of the main reasons for that is we've seen really strong land-led flows continue from last week into this week, as we've seen Norwegian production remain really strong. On top of that, we're seeing higher imports through the BBL, which is a pipeline that connects the UK to the Netherlands, and again, high production is resulting in increased flows coming to the UK. In terms of demand, it's relatively neutral. In terms of temperature forecast, we're expecting largely seasonal norm temperatures this week, which is seeing local distribution zone demand relatively neutral. In terms of exports, we have been exporting quite strongly through the IUK, the connector between the UK and Belgium. However, because of the recent increases in UK gas prices, the discount in UK gas prices to the continent has decreased, and that therefore means that exports are less incentivised. Looking at power now, we're expecting really strong wind generation at the start of this week, except that's expected to curtail later on in the week. So that means start of the week we're expecting quite wide supply margins, and that's expected to narrow towards the end of the week. In terms of nuclear specifically, we've only got one generator off in the UK. However, if we cross over the channel to France, they're currently having 12 nuclear sites under safety review. 8 of those are currently offline, and as a result that's seeing really strong demand in France for power supply from the UK via the IFA connector. More widely now, if we look at the pound, it's still really weak against the euro and the dollar, and that's acting to kind of exacerbate the situation in terms of gas and power prices at the moment. Similarly, looking at oil price, it's stayed above $50 a barrel, linked to the growing concerns over possible OPEC production cut, and that's again acting to increase sensitivity on UK gas and power prices. So starting with day-ahead gas and power prices, we've seen the uptrend that's been present over the last few months continue, and at the moment prices are pushing higher and higher. In terms of power prices, we've seen some of the volatility that we've seen over recent months kind of subside over the last few weeks, but we are looking at a sizable premium to prices earlier in the year. In terms of gas prices, although we haven't seen as much volatility in terms of power, we are seeing prices continually kind of tick higher and higher, and that's as a result of us moving into winter and kind of supply-demand fundamental shifting more towards kind of a typical winter scenario. In terms of seasonal prices for gas and power, again, we're both trading at around 15-month highs. The last peak in the market was earlier in October, and at the moment that previous high is presenting a significant level of resistance to prices. Going forward, should prices break through that level of resistance, there's a possibility that prices continue to push higher still. However, at the moment we are finding some resistance at that level and potentially could start to see prices consolidate over the short term. So given the context of rising prices that we've seen over the last few months, those customers looking to place fixed price contracts for the front 12 months should look to do so as quickly as possible. We are expecting potential further price increases as we move into winter, as we see prices become more volatile linked to kind of shifting supply-demand fundamentals. The recommendation from us has previously been to look at fixing out for kind of a 4 or 5 year period. However, that opportunity is potentially gone now in the fact that we've seen prices further out start to creep up in line with those closer to delivery. And there is potential that those prices could then soften closer to delivery. So we're potentially just looking at maybe a 12-month fix, 2 years if you definitely need price certainty, but there's potentially downside in the future, so not necessarily worth hedging out that far. In terms of customers with flexible contracts, attitude to risk is key again. I'd hope that you're already carrying quite a heavy hedge moving into the winter season and again for summer 17. However, beyond that, it's down to attitude to risk. There is at the moment an uptrend in markets out to liquidity, and the potential that prices could continue to increase going forward. However, given the kind of the context that we're seeing, and a lot of this increase is linked to kind of very kind of prudent fundamentals to the moment and might not actually be relevant in a year's time, there is potential for prices to come down. Even still, I'd still recommend having quite a high hedge, because it's always easier to unwind hedges in the future than it is just to sit and look at rising prices going forward.